This is your LMAX exchange technical update for Wednesday, October 11th, 2017. Euro dollar. So despite this latest bounce in the euro, the market still is favoring additional downside while it holds below 118.33 on a close basis. 118.33 is some resistance going back to the 29th of September, and certainly while the market holds below 119.10, some resistance from back in early August, the overall pressure still remains on the downside after the market triggered a head and shoulders top and could be exposed for a move down towards a measured move objective at 115.55. Of course, the medium-term trend is still quite bullish, but when we say that the pressure remains on the downside right now, we're talking on a short-term basis after the market triggered that head and shoulders top that leaves open more room to the downside. So again, this rally that we're seeing right now is viewed as corrective, and only a close back above 118.33 would really take the immediate pressure off the downside, while a break back above 119.10, some internal resistance from early August, would be required to suggest that the market is ready to continue with this intense uptrend that we've seen in 2017. Sterling dollar. So cable has come down towards that 130 barrier, and as we had talked about, the market was expected to be very well supported on the dip down towards the 130 area, given what is now a bullish structure in this market following a breakout earlier this year above a previous range resistance at 127.75. And so if we do see setbacks again over the coming sessions, they should continue to be very well supported in the 130 area in favor of an eventual upside extension back towards and above the 2017 peak in the 136s, exposing 140 further up. Dollar yen. So dollar yen has been trading in a range for much of 2017, and that range has mostly been defined between 108 and 114. We've seen the market trade up again out from the 2017 low that was set back in September down at 107.32. The market has raced higher back above 113. At this point, though, it's stalled shy of the range resistance in the 114 area, so that does suggest that we could still see a bit more of a push up towards the 114 area. At the same time, the market would be expected to adhere to the range and roll over again. So it is possible that this bearish price action that we're seeing this week could now set the stage for a fresh downside extension back towards the range lows, with the market stalling out and avoiding having to trade back up above 114. So overall, right now, the market is trading in the middle of a range, but the pressure remains on the downside. The risk is more tilted to the downside after the market had traded back closer up recently towards the top of that range. Euro Swiss. Euro Swiss has been trading sideways over the past several weeks, but overall this market broke above some key resistance in 2017 at 110 and then 112, and so the structure favors additional upside eventually beyond the recent 2017 high at 116.24 and towards 120 further up. Aussie dollar. So Aussie has broken down below some key support here at 78, and this suggests that we could see deeper setbacks in the sessions ahead towards a measured move in the 75 area. It would take a break back above 80 to really take the recently bearish structure now after the market broke down below 78 to negate that and put the pressure back on the top side, and for a potential retest and break of the 2017 and plus 2-year high at 81.26. So again, focus on 80 above. Only above that level would put the pressure back on the top side, and in the interim, the market is now still favoring being well capped into rallies for deeper setbacks potentially towards the 75 area. Dollar CAD. So dollar CAD has seen a bit of a consolidation after the market has seen a nice correction out from the plus 2-year low at just 120.62. But overall, there is room for additional corrective upside in this market to back towards the August high, which comes in at 27.80. Any setback should therefore be very well supported, ideally ahead of 123, with only a close back below 123 to suggest that the market is looking to resume the more intense downtrend that we've seen in 2017. But again, while the market holds above 123, there's risk for a continued correction up towards that next key resistance at 27.80. Kiwi dollar. So the overall pressure here remains on the downside after the market recently took out some support at 71.32, setting a lower top in the 74.32 area and opening the door for an extension back towards a retest of the 2017 low down at 68.18. At this point, look for rallies to be very well capped, ideally ahead of 73, with only a pushback above 74 to compromise this bearish outlook. SPX 500. The S&P 500 has traded up to another record high. The market has shown no signs of any form of a correction as of yet and would need to take out support at 24.87, the low going back to the 25th of September to take the immediate pressure off the top side. Until then, scope exists for additional gains despite the market being highly overbought at this point. Gold. So gold has seen some intense setbacks over the past several months, but each time the market has pulled back sharply, it's been very well supported and overall making higher lows and higher highs. And so this latest round of setbacks was viewed as corrective, with the market ideally seeing a higher low ahead of 1250 in favor of the next upside extension back towards and through the 2017 high in the 1257 area and towards the 2016 peak at 1375 further up. Ultimately, though, only back below 1200 would compromise the constructive outlook for gold.